So why aren't these guys going to like Wells Fargo, Bank of America? Why are they coming to you?
That's a great question. I would say a majority of my clients are what I call bankable, right? They've got the credit, they've got the cash, they've got
They are bankable. Interesting.
Yeah. And so I was just having this conversation with somebody the other day, and they said, well, why in the world would they not use you?
Why would they?
Why
use
would
you?
they use me? Excuse me. Yeah. There's a product for every person out there, right? For my clients, it's speed and convenience. They don't have to go through all the rigmarole
The underwriting
of Wells Fargo, right? Yeah. You know, there's obviously some upfront underwriting things that goes on when I first do a deal with somebody, but then that's kind of set to the side, and now we're just focused on the deal. Whereas with Wells Fargo, you got to do the underwriting. You've got to submit your tax returns every single time. And so you've got those bank avenues, which are great for maybe an MLS deal where you've got 30 days to close. And you've got inspections, you've got all this stuff. But I would say a high percentage of my clients are, we need to close and we got to close this thing.
Well, and the types of deals that you're lending on, though, Wells Fargo may or may not even lend on, right?
Correct. Yeah. They may be so disheveled, right, that they're, in fact, we just did one not far from here that hoarder. I think he's pulled out 12 30-yard dumpsters.
Yikes.
Yeah. And so, any Wells Fargo, banker, they're going to be, we're not touching that thing with a 10-foot pole. Yeah. I walk into there and I'm like, it smells like money in here, right? It's a great property. And I love stuff like that, right? Because he got it at such a discount. And that was an off-market deal that he had sourced. I don't recall exactly where he got it, but through his.
Yeah, because Wells Fargo is not lending on a house that doesn't have a kitchen, roof's busted, all that kind of stuff. So the types of deals that you're lending on, they're all primarily having to get fixed up, right?
Oh, yeah. I would say a majority of them. There's a few occasions where somebody just stumbles across a great deal and they're going to throw some lipstick on a pig. They're going to paint and carpet and things like that. We call that more wholetailing, right? They're going to buy it, turn around, put it right back on. But a majority of the guys are doing, I would say, pretty substantial remodels. We don't, or I don't see a lot of like pop tops or development and things like that.
So you're not lending on those types of things?
Typically, no, I'm not. I do have some new construction stuff that I am lending on, but those have been long-term clients that they've kind of evolved into that.
Because they built the relationship with you.
Exactly.
And when you think about a hard money lender, like a hard money lender, correct me if I'm wrong, cares more about getting their money back than even the return on their money, right?
100%, right. Yes. Protection of principal is always most important. When I first started doing this, which has been, I think I first did my first loan in 01, 02, something like that. So going on a long time, I heard the term loan to own and I was like, well, what does that mean? And there are probably still lenders out there who are like, ooh, that's a great deal. I'm going to loan knowing that they're going to fail.
No kidding.
Yeah. I have always said, I don't want any part of that, right? That's just not my model. And so I tell people up front, like, it needs to be a win-win, right? If I loan you money once and for some reason, God forbid, I have to foreclose, you and I are probably never doing a deal.
Never again,
right? Yeah. Because you've got a bad taste, I've got a bad taste. Yeah. I want to loan you money, you pay me back. I hope you make a handsome profit. I do well on my side and we go do it.
And we keep doing it over and over and over.
Infinite.
I mean, you've got guys that I want to get into that in just a second, but what makes it that you are comfortable as a hard money lender lending on a house that even the big banks like Bank of America and Wells Fargo won't lend on? What makes you comfortable doing that?
Another great question. I think when I go look and analyze a deal, I'm going to analyze the collateral, right? I'm going to analyze the borrower. What skills do they have?
Now, you're not pulling credit?
I don't pull credit. No. Yeah. Have you ever heard of the 4 C's, right? Collateral, credit, cash, and character. Yeah. Right. So the only one I don't do is the credit part, but I'm looking at the collateral, I'm looking at the cash on hand that they have, and I'm looking at the character of the person. That's an important one to me. That's important to me because, like we just talked about, I want to get my funds back, right? And I want you to be successful. And so I want to deal with high character people that are going to.
So when you're lending, are you lending just on the purchase price, or are you also lending on the rehab?
Now you're asking loaded questions, right? Yeah.
I'm trying to figure out what I get out of you, Drew.
Just play defense. It depends, right? Yeah. I've got some clients.
And it can be sometimes.
Yeah, it's a sometimes question, right? If I've got a client who comes in and says, man, I just got this property that's worth $400,000 and I just picked it up for $100,000 and it only needs $100,000 worth of work, I'm going to loan the whole thing, right? Like, okay, so I'm into it at 50% LTV after fix up. Yeah, it's a pretty no-brainer.
What loan to value are you typically trying to get at?
I like to stay sub 75.
Sub 75.
Yeah, my goal. And with the people that I'm loaning to, they're usually getting deals that exceed that.
Far below that.
Yeah, far below that.
How often are they having to put some of their capital in either to rehab it or whatever. So in that example, $400,000 house, 75% of that is 300 grand. So in that case, you would be willing to lend up to 300 grand. If they bought it for 250 and it needs 100 grand worth of work,
They're bringing some
cash to it. They might be able to squeeze 50 grand out of you.
Right.
They may not be able to, right? Hey, I will lend up to, but on this one, I'm just going to do the purchase price, right?
Well, and the funny thing, using my electrician example, when he was first getting going, he didn't have a ton of capital. He's done enough deals. He's got a lot of capital. And he looks at it and says, I'll put a little more of my own capital into this deal. Back to your question about why using hard money. What a lot of my clients are is they can do, they may have enough cash to do a deal by themselves and don't need a hard money lender.
How difficult is that underwriting process? What does that typically look like for you?
Typically, it's going to be the client sends me an email, says, hey, Drew, I found 123 Main Street. Here's my numbers. They'll send me, hey, here's my comps. And then I will take that and go and do my own comps.
Regardless of
if I've done 100 deals,
yeah,
right?
I'm still doing some homework.
I'm still doing some homework. Yes, I'm not stroking checks just willy-nilly for sure. So I'll do my own homework, do my own due diligence, and then I'll come back and say, yeah, I think you're spot on. Or Denver, for example, right? We know what's going on here. Our inventory is shooting up. We got to be careful. Are we catching a fallen knife, right?
That's right. So that's some of the thoughts going on in your head.
100%.
Because these projects are not. How long are these projects lasting?
I would say 6 months, 6 to 9 months.
6 months.
So that's pretty quick.
That's pretty quick, but things can happen in 6 months.
They can.
Were you lending back in 2008?
I was.
How did you navigate that?
That's probably when I got into it more full time. So I was buying a lot at the auction.
Yeah, that's how we met.
That's how we met.
Yeah,
was actually buying my own properties, flipping my own property. So I was going to say, you had asked a question before about when you look at it. I also look at a property and say, if I had to take this back, can I?
Oh, so that's part of your underwriting.
That's part of my underwriting. I do have some experience. I just quickly learned that I enjoyed about the first 85% of a flip when you saw the drywall come out, you saw all these big things happen. But I wasn't very good at that last 5 to 10%, which in my opinion is the most important 5 to 10%. Meaning you're going through with a fine tooth comb and you're blue taping every single thing. And it's that minutia and that attention to detail.
Really? Yeah. I had no idea.
Yeah. So because it's really enjoyable to watch the thing get demoed, right? We get a dopamine hit or something when the big steps are happening. But when you walk in and that kitchen's been in for 2 weeks and the floor's been in and you're like, what are we missing? And I can see it. Like I can do, it's like consulting, right? It's much easier to point out somebody else's flaws than your own. Yeah. So when I walk into clients, I can say, hey man, that drywall looks terrible. You need to fix that, blah, blah, blah. Yeah. But when it was my own, I think I was just impatient.
The outlets are still not put together.
Right.
And,
yeah.
and
Or that plate's crooked.
That plate's crooked or something like that. So we do say, right, the last yard is the hardest yard. And so that's what got you. I had no idea. That's what got you into hard money lending. Yeah. You would rather just lend the money. Yep. You're not making as much money though, or are you?
Well, I think I do pretty good, but not as a flipper.
Someone who's flipping, right?
Right. And I'm a pretty naturally conservative guy, and so the lending probably fit my personality a little better. There's the risk profile is definitely less, right? The return isn't obviously fixed, right? We know what the interest rate is and points and all that.
I'm going to ask you, what are your points and interest rates?
Well, I'm going to defer and say it depends.
Give me a range. Or not yours. What's a typical hard money points and interest?
When I got into this business, there was hard money, which tended to be a lot of guys probably like me who are kind of more private lenders who are loaning their own capital. So typically high rates, high points. And then it's kind of shifted where you had this, basically Wall Street money, right, came in and these big funds started coming in and they push rates down and points down. And they're kind of they're a mixture, right? Like I explained about how I would loan to somebody. We build a relationship. Hey, we can close this thing quick. Versus we got banks over here who's going to be so much due diligence. And those guys fall probably somewhere in the middle, right? You're still probably pulling credit. You're still filling out apps.
Getting a beer with their guys at the end. But they're not Wells Fargo with a rectal exam. Right? There's no stool samples involved, right?
Correct. You're not pledging your firstborn.
Right. But there's a couple of bits of underwriting in that where you're like, wait a second, they may get an appraisal. They may get an inspection. You're not doing any of that kind of stuff.
And I tell people all the time, there's a very prominent, great lender in town. We all know who they are. And I call them kind of a quasi hard money lender, right? Their rates are a little less. Their points are a little less. But I've had many conversations with people that are like, oh, well, these guys will do it for X. And I said, well, that's great. You are right. but start adding up all their fees.
Right. And that's just part of their business model.
It's part of their business model. I'm not saying it's wrong by any stretch of the imagination, but when you get down to brass tacks, it's really not that far off.
Hey, thanks for watching. I've got a free video of my capital raising template. Follow this QR code, click this link, and download your free capital raising template now.